Hi, this is John Turk, and I'm one of the directors here at Fiduciary Pension Partners. And today's financial wellness session is on understanding your paycheck as well as federal income taxes, Social Security income taxes, and we'll touch a little bit on state income taxes. As I mentioned, understanding your paycheck and taxes. We'll also talk about tax breaks, those include deductions, exemptions, and tax credits. For 2025, we'll also take a look at the 2025 tax rate schedules and some of the more common deductions. And then we'll finish off with a couple of different strategies on ways that you can potentially minimize your taxes. We've got a great slide here, great visual that talks about the variety of taxes that come out of your paycheck. And this is an example of, well, really, it's a pay stub. Most folks now get direct deposit. So you can see that on the left, right? Here's a good example of a pretty common pay stub, starting with the company name, the employee name, and we're starting on the left with gross earnings. This employee has an hourly rate of $10 per hour, works a 40-hour week, and so they've got a current gross pay of $400. Now let's take a look at the taxes that come out of that. The first we see over here is FICA and Medicare, right? And FICA is Social Security, and that comes to 6.2%. And then Medicare on top of that is a flat percentage of 1.45%. So taken together, you get 7.65%. Now there are ceilings on both of those. For FICA, for 2025, the taxable wage base is up to 176,100, and then for Medicare, it is a sliding scale above that. Also, we see federal income tax, and we see in the case of this paycheck that comes to $44.50. And then we also have a state income tax of $35. And when we think of state and local or city taxes, right? Um, that might be in New York or New Jersey or for New York City. That can range, if you think about New York, maybe in the 10, 11% range. California comes in with the highest state tax, that's 13.3%. But at least in the case of this employee, that deduction comes out to $35 per pay. What we don't see here are other deductions that might be for health insurance. Maybe you've got a dental insurance policy through the group, potentially life insurance, and of course, maybe a 401k or 403b payroll deduction. So for this employee, they started out with $400 out of the gross, and we can see down here what they are netting. That net pay is coming out to $289.90. So you can see the impact that taxes have on your gross pay. Now, in the US, we utilize, and we're talking federal taxes here. States work similar. Some states work similar, I should say. But when we're thinking of the federal tax system, it is a marginal tax system that we use. So what does that mean? So if we're thinking of an individual who, and these are utilizing current tax brackets, so for an employee or an individual who earns $19,750, the tax rate on that first 19,000 is 10%. So if they, after deductions and whatnot, their taxable income is 19,750, they are going to pay taxes of $1,975. However, let's say that they earn more than that. Let's say their taxable wage base comes out to $60,500. They are then going to pay a 12% federal income tax on that amount above $19,750. So that's about 40,000. So 12% of that tax is $7,260. So you can see um, for this individual, they're not paying federal taxes of 12% on their entire taxable wage base. You can see how that is segmented out and broken up. And then if we look further to the right, an employee who earns more than that $80,250, let's say they earn an additional, or they have an additional $90,800 in a taxable wage base. Well, for that segment, their federal income taxes come to 22,000. And you can see how that works out. And I'll use an example here for an individual earning more than, or having a taxable wage base of more than 326,600. That goes all the way up to 414,700. So for that $88,100, they are going to pay federal taxes of 32,000. So if we kind of take the whole thing of 420,000, utilizing these, adding up these taxable wages, comes to 420,000. This individual will pay $96,590 in federal income tax. Now that effective rate comes to 23%. So 23% on the 420 is just under $100,000. That's federal income tax. What this does not include is any taxes that the individual might have paid for Social Security or Medicare. And as we spoke about on the last slide, that is essentially Social Security is capped to, like I said, 176,000, and that's basically 6.2%. So as we think about it for individuals, we hear somebody might be paying in that, say, in that 37% tax bracket, which is the highest. It doesn't mean that they've paid 37,000 on all of their taxable wages. We can see that that individual would those individual segments, those individual buckets, if you will, along the way, have those different tax rates applied to it. And that is how we get to the effective tax rate. Now, let's talk about tax breaks. Sometimes people call them tax loopholes. What are they? What are most valuable? We first start off with deductions. And what a deduction is literally reduces your income that is subject to tax. So let's say you've got a gross income of 100,000 and you've got 10,000 in deductions. Well, for that individual, they would then have a taxable wage base of 90,000 and then pay the appropriate taxes associated with that. So that's how a deduction works. Some examples of deductions include what is called the standard deduction, and maybe you've heard of that. That differs. There's an individual standard deduction as well as a marital standard deduction, and those amounts are going to be different. Another example of a deduction might be if you own a home and you pay interest on your mortgage, that interest may in fact be a tax deduction for you. Let's talk about exemptions. These are dollars that you get that maybe you've earned, or and another example might be if many times if you've invested in what is called a municipal bond, the interest or income that investment kicks off, well, that isn't taxed. That's an exemption. That is a great example of income that is not taxed, and that is not that uncommon. Then the last we have here is what is called a credit. A credit represents a dollar for dollar reduction in taxes owed. So let's say you have a tax credit of I don't know, $2,000. Perhaps you've purchased an electric vehicle. Those sometimes come with tax credits. But let's, for this example, think of it as a $2,000 tax credit. When you file your income taxes, you find out that maybe you owe maybe before that credit is taken into account, maybe you find out that you owe $5,000. Well, that credit could come into play. That $2,000 credit could come into play and reduce the taxes that you owe. So if you take the $5,000 minus the 2,000 representing that tax credit, you would then owe $3,000. At the end of the day, if you think about these, the credit really represents is the most valuable, with the exemptions not being far behind. Because again, if you think about it, that's income coming in that you are not paying taxes on. And here we see for 2025 the tax rate schedules. And typically, we look at these as folks that are either a single taxpayer or perhaps married, and filing what is called a joint return. So we've got a couple examples here. So for a single taxpayer who is earning 11, we'll call it $12,000, their tax, the amount that is gross, or excuse me, the amount that is taxable, is actually going to be 10%, and that is taken into account before deductions. For that individual who maybe earns a little bit more, that the tax between 12,000, and then that next uh, bracket goes all the way up to $48,475. For that individual, that income is going to be taxed at 12%. And you can see how that works out. If we'll use another example here in the single, for an individual that's single, right? And they're earning over 103,350, but not more than 197,300. So that $84,000 difference is going to be taxed at 24%. If we look at the individual side of things, or excuse me, those folks that are married, and filing a joint return, the income from 0 to $23,850, the taxable rate is going to be 10%. North of 23,850 to 96,000, so you're talking about 73,000 there. That's going to be taxed at 12%. So you can see how that plays out. Let's say we've got an individual who's earning 206,000. North of that, 206,700 to almost 400. So that, call it $200,000 difference, is going to be taxed at 24%. So again, when you're doing your taxes, you kind of take all these brackets together and you add up the amounts here, and that is you were ultimately paying in taxes. So again, you think of the prior screen, the individual earning over 400,000 with an effective tax rate of 23%, basically paying 96,000. And let's talk about standard income tax deductions. And these have grown in popularity as the numbers have increased fairly substantially recently. So for an individual who is single and you want to take the standard deduction for 2025, that amount is 15,000. So if you were to say earn 15,000, you take the standard deduction of 15, your taxable income is now at 35,000. If we look at an individual who's married filing jointly, that standard deduction is now 30,000 for 2025. So let's say between a married couple, who earns, I don't know, call it 150,000, their taxable wage base would be 30,000 if they're using the standard deduction. If somebody is filing, either call it married separately, so we can see the similarity between married filing separately as well as single. Someone who is filing as head of household, their standard deduction would be $22,500. And you can see over the years how that has increased as these numbers are indexed for inflation. So now I know we hear a lot of folks talking in, say, March or April about their tax refund, a large tax refund. And a large tax refund is not necessarily a good thing. Now, psychologically, you may feel good about it to get a refund at the end of the year. But the point here is that the government has essentially had your money for the whole year, used it, and then gives it back to you, but they haven't charged you interest. So it is like you are giving the government an interest free loan. However, uh, financially, it is better to actually owe the government at the end of the year. In that case, you would have had been able to utilize all of your money for the entire year. But sometimes, especially if what you owe is substantial, obviously that can leave a dent in the financial pocketbook. So it is something that you want to plan for. And typically, one of the strategies that you can use. So for some folks where they don't want to get too much back, or they don't want to owe too much at the end of the year, you would adjust your deductions and exemptions on your W-4 form to manage through that. Now, the 401k plan or 403b plan, and quite honestly, between the two, there's much more similarities than there are differences. So when we say 401k, we can easily substitute 403b. It's a very good way to take advantage, minimize your taxes if you're using the 401k or the 403b on a pre-tax basis. Because what happens is, and we'll see this on a later slide, if you're using the pre-tax concept, every dollar you put into that 401k or 403b has a dollar for dollar reduction in your taxable income. So think of it as we spoke about on the deduction side. And so, here we've got an individual who is, say, earning 50,000. They contribute 6% of that, $3,000 per year into their 401k. Their average salary increase is about 2.25%. Excuse me. And the organization that they work for matches that 50% at the end of the year. Excuse me. And they're investing it in kind of a balanced fund, 60% S&P 500, 40% aggregate bond index. And let's say they do that for 50 years. So if we're thinking back to the end of 2022, and this individual had done that, they would have accumulated 541,500 dollars in their 401k plan. Now, it is important to remember that this person is using the pre-tax bucket, and they will be taxed on those dollars, what they withdraw when they withdraw it. Now we kind of see somebody who is using maybe a savings account or a mutual fund on an after-tax basis, and that's okay too, right? The important thing is that both of these folks are saving and investing for the future. But you can see with this individual on an after-tax basis, they accumulated $432,300 over that same time frame. But assuming that they paid taxes on the capital gains and interest along the way, this bucket is tax free. Little difference there. And as we were just talking about pre-tax or before tax, sometimes folks refer to it as the traditional 401k or 403b. This slide is a good illustration of how pre-tax contributions to either a 403b or a 401k work. So while you're working, right, you're going down the highway making before tax contributions, those dollars go into the plan before you pay taxes on it. And when we say before taxes, that is before tax on the federal, state, and if you have city income taxes, it's before city income taxes. So typically, what we say is for every dollar an individual puts into it on a before tax basis, it reduces their take home by about 72 cents. So if you're going to put $100 per pay into the pre-tax side, you will see your take home reduced by about $72. Again, that's the advantage of before tax. In addition, any interest or earnings that you earn on those dollars in the investments within the 403b or 401k, those accumulate tax deferred as well. Now, you will pay taxes on this money what you withdraw and when you withdraw it. That's when the tax bill comes due. And typically, you can take your assets out of the 403b or 401k when you hit 59 and a half. Now, you don't have to take it, but you can. And again, you are then taxed on what you withdraw when you withdraw it. Also, if you were to leave your employer, typically you can take your money. If you were to say roll that into an individual retirement account, which is perfectly fine, that avoids those taxes, the tax consequence. If you leave the job and you again take the money out and spend it, well, that's going to trigger that taxable event. Now, something else that's important to remember is age 59 and a half, and we kind of just touched on it. If you're older than age 59 and a half and you take a withdrawal, you pay the income taxes. If you're younger than age 59, let's say you're age 50 and you were to leave your employer and take the money and spend it, you're going to pay the income taxes associated with that withdrawal, and a 10% federal excise tax might apply as well. Ways to avoid the taxes, the excise tax, whatever might apply, roll it over into an IRA, or conceivably roll it into if you go to a new employer and they have a plan that allows, you can roll it into their plan. Or we find most individuals like the flexibility of rolling it into an individual retirement account. And again, those last two avoid the tax consequences and penalties. Now, we were talking about the pre-tax. Let's talk Roth, right? And again, this is a good visual with Roth 403b or 401k. Your money goes into the Roth after you pay taxes on it, right? So if uh, if you put $100 into the Roth 403b, you will see your take-home check reduced by $100, right? It's after tax, and you say, why would I do that? What's the kicker? What's in it for me? Well, if you are contributing on a Roth basis, like I said, those dollars go in after tax, but any earnings, interest, dividends, capital gains can come out tax free, assuming it's a qualified distribution. And you say, well, what's a qualified distribution? Older than age 59 and a half, and you've had the Roth account for at least 5 years. You do that, those earnings. Now, your contributions, the money you put in, that went in after tax. Okay, so you're not going to pay the taxes on that on the way out. But for that interest and earnings to come out tax free, you've got to be older than 59 and a half and have had the account open for 5 years or more. So that's how you get that advantage. And we get questions all the time. Should I do one as opposed to the other? You can do both, right? So if you wanted to do, a total of 10%, five pre-tax, five Roth, you can certainly do that. Kind of hedge your bets. Typically, we kind of say folks that are maybe younger want to take advantage of Roth. They might be in a lower tax bracket at that point in time, so Roth makes sense. Um, and when we say folks that are younger, typically age 40, younger than age 40, um, as you uh, age, and the thought is your income grows, as you age, and if you think you're 45, 50, or north of that, your income might be at its highest. So then you're paying at that point, paying the most taxes. So for those folks, pre-tax is going conceivably make the most sense. But again, you can hedge your bets, and everybody's situation is a little bit different. And if you have questions on that, we'll have a way for you to get in touch with us at Fiduciary Pension Partners. We are available for complimentary one-on-one consultations where we can talk about your individual situation, how this can work for you, um, and answer any questions or concerns that you might have. Okay, so this is another visual, trying to explain the difference between pre-tax and Roth, right? So again, we've got an individual on the left side using pre-tax 403b, 401k. The gross income is $2,500. They're contributing $200 per pay. That comes off the taxable income. They're paying taxes on 2,300. And again, these are just examples. But in this case, we got a federal tax of 20%, state taxes at 5%. And so ultimately, this individual, their take home is $1,725, right? So what we don't have here is we don't have FICA included, and we don't have any life insurance or health insurance, but those might come into play as well. If you think about the Roth concept, right? Talking about Roth, it comes out after tax, right? So even though this individual is contributing $200, it comes off the top. So they're paying federal taxes now on the full 2,500. They're paying state taxes on the full 2,500. You can see what those come out to. If they put the same $200 on the Roth side, their take home is reduced by $1,675. So you can see there's a $50 difference between the two, and that difference is really between the federal income taxes paid, right? Between pre-tax and Roth, that's a $40 difference. And then the other $10 difference in this example comes from the state income tax side. So that concludes our discussion of your paycheck, taxes, Roth, pre-tax, how the marginal tax rates work. I know we've thrown a lot at you, but if you have any questions or concerns, should I do Roth, pre-tax, anything like that, if you want to involve a spouse or partner or another trusted advisor in the conversation, we're here to help get your questions answered, get your concerns addressed. You can give us a call at 908-224-2377 or drop us an email at info@fiduciarypp.com, and we're happy to schedule those complimentary one-on-one sessions. Like I said, make sure you get your questions answered and your concerns addressed. That concludes our discussion tonight. We hope you found it informative. And like I said, if you have questions, feel free to give us a call. Thank you.